With a changing market, investing success requires a clear strategy and a track record of performance. If you're serious about building a property portfolio, you need to speak with Lachlan Vidler and his team at Atlas Property Group. As a national finalist for 2022 Buyer's Agent of the Year, Lachlan and his team are ready to build and scale your portfolio in any market. Whether it's financial freedom or a more secure future, Atlas Property Group is here to guide and support your personalised journey. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. I imagine your pulse is racing like most Aussie investors right now, trying to get a sense for how far, how long this rising rate environment will continue, what will happen to property prices. You're getting very conflicted commentary coming out of a lot of the media outlets, a lot of them still propagating the merchants of doom and gloom, and this is the crash that we've been waiting to happen, whereas others are saying the price reductions that everyone was forecasting, what the banks have been forecasting, have already happened largely. There may be a little bit to go, but there may be time for things to start going north. Some people are calling the bottom of the cycle right now, and we talk about the cycle, which state, which area, which location, who knows, horses for courses. But everyone's an expert at the moment. There's a lot of armchair warriors out there who are propagating all of the value of investing in real estate in Australia. And on the flip side of that, you've got all the people telling you stay well away from it and start chucking money into Aussie equities or other asset classes. So who knows? Who knows what to do? Much like me, you're probably sitting there thinking, all right, I've got to find out more about this stuff. And how do I do that? Well, you can tune into the Smart Property Investment Show, but I've never really said I know much about property. I'm pretty good at talking to people about it, and that's my job, to help you shape and steer your decision making. And I like to think I have a sense of curiosity to ask the questions that you're probably thinking right now. And this show's been, in many ways, I think a good driver for helping Australians invest better than that what they would have done. It's been a source of information, inspiration potentially for a lot of investors. And I know, and we get a lot of feedback, both personally and over email and all the stuff, that we've actually made a substantial impact to how people have started their property investment journey and embarked on that process of wealth creation and are now right smack bang into it, trying to calibrate their portfolio through this period. So a lot of investors have started as a result of listening to this podcast. A lot of investors still continue to listen to this podcast as they go through this acquisition period and start thinking about maturation of their portfolio and even the backside of it, where we sell down. And I like to talk about the selling down side of things, or transacting property inside a portfolio. Maybe doesn't get as much love as what we should do, so I'm putting more focus on it. And today, this is really where I want to point this particular chat, not about, hey, you're a first-time investor, where should you buy? It's more about, hey, you've been investing for some time, and this market is presenting opportunities depending what's inside your ears and the way you see the world and where your mindset sits and who you're listening to or where you're getting your advice from. But some of the smart minds are saying that it's a good time to buy. And we've all driven past the Chemist Warehouse and seen those big signs out the front that says for sale. Everyone loves a sale, myself included. So maybe it's the hottest sale in town. Maybe it's JB Hi-Fi's clearance sale. Maybe you love a sale. Everyone loves a sale. I know Paul Glossop does. He's the director of Pure Property Investment, loves a sale. That's his job. He finds people property, particularly those who are transacting in and around property rather than those first-time buyers. That's where he's focusing a lot of his attention right now. Paul, is it sale of the century?
Well, Phil Tarrant, you've done it again. You never cease to bewilder, amuse, and probably make me yawn in your long, laborious introductions. But, mate, I do appreciate the fact that I think one thing we haven't done for a long time, and I think one thing that I guess a lot of the times listeners in this space, and also would be and early and even mid-time or mid-tier property investors don't really realize that much or get to the point that much, is how do I actually realize or get all this to fruition to the point of where I actually wanted to get to, and speak about how do we get there and what are the steps to get there. And when to buy in your discussion about things being on sale, mate, because this is the big one right now, is that we've had a little bit of a chat on off air on this, is that unfortunately I think property is probably the only thing which, as property investors and property owners, is that a lot of the time people think that the best time to buy property is when it's going up in value as opposed to when it's actually going down in value, which take that out of the equation. Everything else in life, you're wanting to buy at the bottom as opposed to the top.
So Paul, paint me a metaphor. I'm driving down Parramatta Road looking at used cars, and at every second block there's one of those blow-up men flapping his arms around, sort of wobbling in the wind, trying to entice me in to buy myself a 1997 Datsun Stanza. I haven't done this for years, but I remember doing it as a youth. But everywhere I go, if that's the Australian property market, is there for sale for special signs and quick buy now, beat the crowd? Paint that picture for me.
Well, mate, firstly, Parramatta Road, you definitely haven't been on there for a long time, because there's been some big acquisitions and big buybacks there, because there's light rail that's been under construction there for quite some time. So there are no more dancing men. And those times of cheap cars are also behind us, as you no doubt know. You can't buy a cheap car anymore because a used car is an expensive used car these days. No longer are you seeing that was 10 grand, now 7 grand. It was 10 grand, now 14 grand. Imagine seeing that sign and how you'd react to it. But look, yeah, the reality is that I actually only just got off a call about 2 hours ago with a client of mine, and they sort of gave me that we're starting to buy their, I think, 6th and 7th assets. And the reality is that they asked me about the state of the market. And I guess the resounding position is that we're entering into a normal market. Now, that is the crux of where we are. And a normal market, I typically find, is defined as you've got some markets that are going up, some markets that are going sideways, some markets that are going down. The bigger markets, as far as i.e. Sydney and Melbourne in particular, which control the bulk of the transactions, the bulk of the volume, are certainly the ones that are reducing in value quicker and more aggressively, which in turn will take your national averages way down so everyone thinks it's doom and gloom. To that point, mate, there's some definite places and bargains that are starting to be had in the Sydney market. If you've got a 5-10 year horizon, there is some very, very good shopping to be done right now. The biggest key, though, is cash flow, because as we know, we're in the thick of interest rate increases, and we've probably got a couple more to come before we're at the top of this cycle. So although property's cheap, you've got to be able to make sure you have a mindset and also a forecasting model to say, can I afford to hold this not only in the next 12 months, but the next 5 years, because that's what's going to bring a lot of would-be investors unstuck. So yes, mate, there's some genuine specials in places that I'm personally buying in the Sydney market right now, so kind of in that mid-tier and even upper-end markets, because the reality is that the lower-end markets have held up really well, and I think they'll continue to do so. But those mid-tier and upper-end markets, as well as in Melbourne, they're the markets that have shed some timber pretty quickly, and I think they'll continue to do so for the next 6 months. Take that out of the equation, though. You've got other markets which are probably a bit more of a balanced position, be it Adelaide, Perth, Brisbane, although Brisbane's last couple of months of data has been a little bit soft. I don't expect that'll be a long-term aspect.
I've been chatting about this as we've entered this new cycle, this upwards rate cycle, softening price cycle that buyers agents are really moving into the fore. I want to have a chat to you, Paul, around this concept of under market value property, right? Now, is under market value property a sale? Is it, I don't know what it is, but how is your lot, i.e. buyers agents, yourself specifically, quantifying this notion of under market value? Is it finding stuff which is considerably under what it topped out at, and that last upwards price cycle? Or is under market value look differently now? Is it under market value based on where the market is right now, or what you think you're buying it at, where the prices will come down to? How you sort of narrating that?
Yeah, it's a good question, Phil, because I think the reality is that the definition of that is very skewed, and it depends on which market you're talking about. Because if you bought, I'll give an example, I've got an offer on a property in Sydney at the moment for $1.4 million. The asking price at the moment is 1.5 to 1.6 is the guide. And at the moment, there's no bites there. I'm holding firm at 1.4. I think the reality is I'll probably pick it up in that mid 1.45 range. Now, 12 months ago, if you bought a property below asking price, you'd say that was an absolute screaming deal, regardless what the asking price is. But am I basing the value on what it was sold for, what it would have sold for 12, 14, 18 months ago? No, we can't do it on that. We've got to base it on what comparable sales are happening and transacting for right now. So the reality is that you've also got to understand what's happening in the forward forecasting aspects of those markets. And Sydney, as an example, we don't expect it's going to see any upward trends over the next 6 months, possibly even 12 months. So if we're buying now, we're not buying in the sense that we need to factor in more growth coming. So if we buy that example 1.45, well, that's a $1.55 million property. Well, it's not. Whatever I buy it for, I'm setting the market value. So that's not under market value. And if that market's retracing by 10%, 15% per annum, I could have well overpaid in the next 12 months. But if I've got a 5-year horizon to say, hey, that's a market which we see is going to see continued growth, undersupply, continued increase in rents, etc., there's a way to measure that. That one's a little bit more complicated, that example. But if I give some other examples, and I'll give a really simple one that we're working on for a client in Perth as we speak, which is a 740 square metre R60 corner block, which for those who aren't aware of what an R60 zoning is, for New South Wales standards, it's an R3-ish equivalent. Essentially, for a 700 square metre corner block, we can get 3 dwellings on that property. Where the existing asset sits, we know we can keep that, cut it into 2 additional properties. So long story short, we're buying a block for about 400. It's going to be about 400 grand for the purchase. It's a 4-bed, 2-bath, 1-car garage property. We know we can cleave off 2 additional blocks on that actual property. The property's going to rent for $400 a week. Now, the term of under market value, that actual house, it's about a 24-year-old house. To replace that house in today's market in Perth with construction costs based on the actual condition of that property, that's about $320,000 to $350,000 replacement value. So technically, after all closing costs, we're buying that full block land for less than 100 grand, which can be subbed up to 3 separate blocks if you put another $100,000 into subdivision costs, etc. Equivalent blocks of land in that market are selling for anywhere between $250,000 and $300,000 once fully subdivided and serviced. So you do quick math and you look at that and say, well, if we're buying a property for essentially a block of land for less than 100 grand, the upside based on all that maths about an additional $200,000 to $300,000, and the property's going to rent for about $370 a week. So it's about a pretty close to a 5% yield. Is that under market value? Yeah, I personally deem that to be under market value because people aren't valuing the actual property into what the maximized use of it actually is. And that's all the work that we do when we're going through valuing a property, not necessarily saying how does that compare to another property that's sold in the same street or 2 blocks away? Is it the same price, less, more, etc.? Because that other block could be less utility, it could be less upside, the property itself could maybe not be kept as part of that subdivision upside, etc. So the actual definition and the terminology is quite complex and it is always a case-by-case basis.
Yeah, and for a lot of investors who have been at this for a little while, they're looking, they're eyeing this market as maybe it's time to buy, and they may be rebuying in areas that they may have bought in prior. I know a lot of investors who bought heavy sort of 10, 12 years ago in the city market. It sort of jumped out for quite some time. They're now eyeing the city market as a place to actually get in with at the right time to realise the upsides of this next market cycle it's about when it happens. Now, a lot of people are tapped out in terms of the debt they can take on, particularly as interest rates go up and the serviceability requirements from banks increase. So you may not be able to borrow more money. However, you might be able to swap what you've got for better performing assets. And it's about rejuvenating your portfolio. And that's the point for a lot of investors right now. It might not mean more assets, it might mean different assets. So why not get out of those properties that have performed for you up until this point in time, redeploy that capital elsewhere in markets that will continue to perform over time. And that's where the smart money is right now. And I want to have a chat about that. Paul, we'll just go to a break beforehand, back in a moment.
Throughout 2022, we've already seen a huge ebb and flow in the Australian housing market. Property prices increased earlier in the year, but the rate hikes have slowed down price growth over the last few months. Even so, we've seen more new listings hitting the market than we've experienced in recent years. Plus, with many property owners having accrued a significant increase in equity, the market is hot for investors looking to snap up another property that may have reduced in price. To help you find these properties, the team at Pure Property Investment have done all the legwork to identify the top 30 suburbs that have not only shown growth throughout this year, but are also poised for strong capital growth over the next few years. Grab your free top 30 guide to property investment guide today at www.purepropertyinvestment.com.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop, CEO of Pure Property Investment. Paul, are you getting many phone calls from your clients now saying, I want to swap what I've got in my portfolio? It's time to swap, time to shuffle the deck. Can't take on more debt, but I reckon I could probably benefit from having different type of assets. Is this happening?
Yeah, a lot, mate. And it's quite ironic because it's typically now it's those people we put plans in place anywhere between 3, 4, 5, 6 years ago. Even clients we bought for only 12, 24 months ago in particular parts of Brisbane, as an example, have seen exponential growth. They're now getting to the point of saying, well, I can't borrow more money. However, I want to continue to build the portfolio and recycling to markets which are going to allow me to get further. We spoke about, again, this off air, mate, is that we are getting to the point now where investors who have had, whether it's their owner-occupier leverage off that and bought 1, 2, 3, 4 properties over the last decade, and they've held them for that time, they're now at the point where they have seen really strong growth. However, with this interest rate increase, they're also saying, hey, look, I want to build my portfolio, but essentially my serviceability is tapped out. So you sat here with this stuck equity, but you know that there's opportunity to keep pushing, and you're probably not at the point of your portfolio value or cash flow where you want to be. So you've got to find a way forward. And there's a lot of conversations that are happening. One in particular, I guess a really good example of ours for a client who we've probably bought 7 particular assets or separate assets over the last 6 years for. And they've ranged from 4 in the Brisbane market / Sunshine Coast market, 2 in the Hobart market, as well as 2 in the Sydney market. So that works out to be 8, sorry, not 7. But they particularly now have seen, there was a Hobart property which we recycled that out of. That saw about 110% growth in a 4-year period of time. Now the conversation was saying, hey, is this going to see another exponential growth period? The answer was probably not. So the decision was to liquidate that property, take the best part of $300,000 in profit from that, as well as now gone through the sale of 2 separate Brisbane assets, which were purchased at the bottom of that cycle about 3.5 years ago, which again have seen close to 100% growth. And there's about $550,000 in total profit from those 2 properties. So in total, we're talking about $850 worth of total profit, gross profit, which they've taken that liability off their balance sheet and now looking. So they're still keeping 3 or 4 separate assets. So they've still got really good cash flow, good equity in those. They're going to be long-term holds. But now we're recycling into probably a Sydney purchase for that same client right now, which is going to be more to the tune of about $1 million, 1.2 million. So they've got a big chunk of cash to put towards that. They're going to use the extra cash that came from those sales to offset those other assets, bring up the cash flow. And we're also going to discuss potentially building a secondary dwelling on one of the properties in Brisbane, as well as a subdivision on another property up on the Sunshine Coast. So trying to say, how do we get that same exposure, same cash flow, lower the LVR, but take advantage of markets which are at a much more prime time of buying, knowing that you've already got the maximum of the growth cycle that's already come.
Sounds complicated.
And it's a big part of the service that we always try to provide, to be honest with you, at Pure Property, because the challenge that most people have is that you look at your numbers pretty regularly, and I don't doubt yourself, Phil, as a property investor, you get through this somewhat haphazardly. Every now and then you might just do some back of a napkin calculations of what your debt is, what your properties are worth, what your total cash flow is. And then it's kind of just like a blanket scenario where you put it on, you feel okay, and then you go to sleep, you wake up, you forget about it. Our job is to uncover those and give action points. Now, whether it's do nothing, whether it's to recommend potentially looking at a sell, whether it's to build a granny flat, subdivide, raise your rents, these are all the things that you have to have a bit more of we see ourselves as a coach in that space, because our job is to then get the most out of people's portfolio. Because if you're not at the point where you need to be, and there needs to be particular actions that need to be taken to get there, our job is to expedite that part. And without us pushing, a lot of the time people just sit on their heels. Similar to interest rates, people just sit on their heels and they become a victim of the markets themselves, as opposed to just making sure they take the action to the market.
Yeah, and if you want to go down this pathway of shuffling decks or recycling inside your portfolio, there's a whole bunch of different ways, I call it, sort of portfolio rejuvenation, considering the market dynamics and it's not always the right time to buy in particular capital cities, but I think you'll see a moment in time, if you can move quickly, a lot of it comes down to your ability to secure finance. But to sell down those assets which have done their job and redeploy that money in other areas, it is what the successful investors will do in this market cycle. And you're seeing also, you think about the Perth market, Paul, I know that's attracted a lot of first-time buyers out there. The price differential between what you can buy a house out there versus what the same thing costs you out on the East Coast is very different. And that's, for many first-time investors, the only market where they can actually beef up enough a deposit and secure the debt in order to buy. And that's going to get harder over time as interest rates go up, and therefore what you borrow goes down. But for those who have been at it for a little bit longer, if you're not thinking about recycling or reshuffling your portfolio now, you're going to miss the boat. So how do you start with it? Well, you probably need to know what you've got what it's worth, how much debt you've got, what the yields are on it. And then from that, being quite tactical about, okay, has property X done what I expected it to do over a period of time? How much more has it got to go? And if you decide that it's done the heavy lifting, it's time to redeploy that money, get it on the market and get it on the market quickly. What's the best way to sell property, Paul? Just being decisive, no doubt. You don't want it languishing on the market for quite some time. You've got to find yourself a pretty good agent, no doubt.
Completely. And I think it's a really astute question, Phil, because the reality of selling property, especially as a property investor, is that if you've got a price in mind that you know is not necessarily going to be a record-breaking price, but you know it's a price that makes sense based on all dynamics in the market, be decisive, make it happen, and do not nickel and dime over the small minutiae. I'll give an example of my own, mate. I posted something to our Instagram feed only literally a couple of days ago, which was in particular on a commercial development site that I bought probably best part of 6 months ago in the Sydney market. And at that time, the reality of what happened in that market is that market's basically gone flat since we bought that property. We bought it with the intention of developing it. We paid realistically, I think it was a bit over $4.3 million for the property. There was a lot of additional costs which come with that, GST and stamp duty, which all worked out to be the best part of another $350,000. Here's the key. The key with that is that actual development site didn't come to fruition. The actual construction cost blew out as part of the FISO. I had to buy it quick. I knew that what we were paying for the land was okay, that there was going to be some upside. Now, we ended up selling that property 2 weeks ago, and I sold it. Here's the irony. I sold it off market. Now, you usually say, hey, hang on a second, this guy's a buyer's agent and he's buying property off market, spruiks that that's probably the best way to buy property because you buy it cheap. And he's telling us he sold a property off market. And this for me is probably a lesson for everyone out there saying off market doesn't mean bargains, and nor does it mean that you're, as a seller, that you're actually selling a property too cheap either. The reality, especially in the commercial space, is that if you've got a number of agents who you know have hands down a tight list of people who you know are going to sell to quickly and efficiently, then they're going to get the maximum price. Now, what ended up being, we valued the property about 4.85 million. It sold within 9 days. We went to an open agency agreement with 2 agents off market. They both said they had about a handful of developers / owner occupiers who wanted it. We sold it within 9 days for $5,050,000 and really simple 6-week closing terms. So for me, it's knowing who the agents are who specialize for that property in that area. It doesn't have to be sold on market with a big marketing campaign to get a maximum price or a swift sale, but you need to know that those correct agents are worth their weight in gold. And they're the agents who really are the ones who aren't the flashy suits and the fast cars. They're the ones who are in that game all day, every day, and understand that market like the back of their hand. And that applies to any single market in Australia.
Did you dust any money on that, or it was pretty much a net?
No, we probably made, after all said and done, a touch under 10% gross on that for 6 months in a market that was basically flat the entire time, factoring in holding costs, sale costs, GST, stamp. Yeah, we still made the best part of 10% on that. And that came down to buying well. We bought it within less than 2 days when we knew about it, did our math, knew the zoning, knew the upside. We knew we were buying it at about 2,900 a square metre. It ended up selling for about 3,500 a square metre. We knew that was about the market rate when we bought it. So we looked at it and said, look, ideally we can get this development done. We couldn't, but we knew that there was about a 10% upswing on it. And that turned out to come to fruition pretty quickly.
So that sounds like smart business, because you made a few bucks on the way through, bit of a headache, time, energy, effort, all that sort of stuff, maybe some missed opportunity cost elsewhere, but sort of sitting there going, I just can't be bothered doing a development because I'm not going to make any money out of it. Like, that's the calls you need to make to be a smart property investor.
And that's like to simplify it, that's basically the call we made. I mean, don't get me wrong, we stewed over the numbers, went through so many different scenarios we could. We spoke to 3 different builders, went through detailed tender packages, etc. So it wasn't exactly hey, this doesn't work out, let's just get rid of it. But it's literally the same rigor we apply to a set and forget residential purchase to that development site, is that we need to know what we're buying it for. And we need to know worst case scenario, is this good buying? If we have to sell, are we going to lose money on this? And we always need that to be the answer is no, because if we know that what we've bought is bought well, then we're confident in any single upside. And ideally, the upside becomes much greater the longer you hold that asset for.
Oh, there you go. It's a real life case study. Fortunately for Paul, he didn't blow any dough on it. He still got a habit. Then you make your money on your way in. It's what they say with property. If you overpaid for that on the way in, you would have probably walked away from that with some scar tissue, no doubt. And that's the last place you want to be. Now, we're talking about sort of shuffling the deck. We're talking about, maybe changing up your asset makeup inside of your portfolio. So let's get a bit tactical with it. We'll just go to a break. Stay with us, everyone. Back in a moment.
Have you considered adding Perth property to your portfolio? Momentum Wealth has experts on the ground to help you find the best opportunities in WA. They'll take care of everything from shortlisting and inspecting properties right through to negotiating the best deal on your behalf. And when it comes to managing your property, they have experts for that too. Contact their award-winning team today at momentumwealth.com.au and get your advantage in Perth's property market.
Welcome back, Phil Tarrant from Smart Property Investment with Paul Glossop. Now, Paul, okay, I get the logic. Maybe sell the stuff that you've got that's performed well, that's not going to perform well in the future, and start plugging the capital that you realise from the sale of those properties into areas which can give you another uplift. You can ride the cycle again, get another crack at the market. And we've been talking about Sydney at the moment. I think there's opportunities elsewhere in Australia. So, brass tacks, where are you buying at the moment? Free advice.
You love it, mate. It's not advice. The last thing it is.
Free recommendations.
But I guess.
What do you like? Where do you like it?
I genuinely look at this as a scenario. I don't want to sound, that's a generic catch-all.
It's all about the fundamentals, is it, Paul? It's all about the fundamentals.
No, mate, I'm not going to use that word. I'm getting right on the show for me. But the reality is that I think if you're a first-time buyer and you've got a deposit and you're looking at a 5 to 10-year play and you don't have any exposure in any markets and you need something to be able to allow you to leapfrog and do what you did 10, 15 years ago, Phil, is buy a property that's really simple, that doesn't first do no harm type of Hippocratic Oath scenario. I can't go past parts of Perth right now, parts of the WA market in general. There's some really good opportunities, even sub 400, we're still buying a lot of assets in that market. And your yields are still north of 5% in many cases. Brisbane's had a little blip on the radar, but I'm still confident in the next 5 to 7 years of where that's going to go. The challenge in that market is probably going to come maybe a little bit more in the next 6 to 12 months. There's a couple of uncertainties there, but I still am comfortable and confident with that market if we're talking sort of that 500, 600, 700K price point. So if you're a first-time buyer and I'm looking at getting some exposure into a freestanding established house, exposure in those two markets for me is a really comfortable position. I think if you've already got exposure, however, and you fall into that category of, hey, I've got a couple of runs on the board and I've got some equity and I'm thinking about where to and what to next, because I feel like the Brisbane market's done its dash, Adelaide's done its dash, everyone's talking about Perth, but I don't want to be there, or maybe I'm already there. And I'm happy to spend a little bit more, but take a little bit less as far as cash flow is concerned. There's going to be, and there already is, some really, really good scenarios coming about in the Sydney market and Melbourne markets. Now, this may sound a little bit converse to a lot of our recommendations of freestanding established houses, but we just saw the announcement from the Albanese government only just now talking about the emphasis on skilled labour and skilled workers coming back into this country en masse over the next 12, 24 months. And that same infiltration of people is going to hit Sydney and Melbourne the same way it always does. And it's going to hit the rental markets first the same way it always does for the first 1 or 2 years before they disperse or buy property. And for me, those villas and 2 and 3 bedroom units in those key commuter suburbs, now that can be 10 Ks from the CBD right out to 45 Ks from the CBD. You can still buy 2 and 3 bedroom villas in those markets, believe it or not, for 350, 400 grand that are still yielding 5%. Now, if you said that to anyone, you can buy in Sydney sub $500,000 at 5%, they'd think you're telling porkies. But the reality is they exist. These markets exist. And to be honest with you, they didn't see the same upswing in growth. So if you still want to get those lower price point assets, but you want to get some exposure to our bigger cities, there's opportunities there. If you're happy to go a little bit more in that price point, there is definitely some opportunities in those freestanding houses, circa either side of $1 million in both Sydney and Melbourne right now as well. And those opportunities will play out for the next probably 6 or 12 months. So I think there's good buying there if you've got the cash flow and the liquidity to get in there sometime soon as well.
Okay, pretty reasonable. Do you like inner city markets, Paul, or would you be thinking more of like out in the sticks? The sticks being sort of the satellite, like if I'm thinking Sydney, I probably shouldn't really call it the sticks. If I'm thinking more sort of satellite places like Liverpool, Campbelltown, Penrith, Blacktown, Hornsby,
top
Sutherland.
10 CBDs in Australia.
Yeah, that's what they are.
They are. I mean, it's ironic, but because we just simply can't call them that anymore, right? Because these are literally million-plus population cities now. I'm still confident in the 10, 15 years of these CBD locations that are a bit further out. I genuinely don't think that there's a really clear recipe as to what the new world looks like as far as those sort of commuter rings that are 5, 10, 15 Ks in the CBD where people are like, oh, that's where I have to live because that's the aspirational areas for villas or apartments or townhouses, unless they're very cheap and they've got rezoning overlays and a few other things. So I'm confident in the suburbs, call them the classic, the old school quarter acre block suburbs, which they're not quarter acre anymore. They're typically 300 to 600 square metre blocks, but they will be robust because in particular in Sydney, where you look at the next 10 years of infrastructure and you talk to any company who's invested in or is part of that infrastructure program, there is more money going into the west and southwest of Sydney in the next 10 years than there ever has been in the history of this country. So that's not going to let that market fall to a point where unemployment and demand for essentially safe and good accommodation is going to fall away. But I think where I'd probably avoid right now is those lifestyle areas. And we spoke about this good 12, 24 months ago, mate, is that they're the ones which, if I'm looking at any markets which I don't see where it's a good time to buy, I can't see the data showing me when there's going to be a good time to buy anytime soon in those hyperinflated lifestyle markets up and down the east coast of Australia in general. But even if you go across to the west coast and any market, any sort of 2 to 4 hour reach of a major city in those areas which just absolutely ballooned, for me, they're going to be your number one areas which are going to see these astronomically bad numbers. And I'm sorry to say that for any listeners who want to go against what I'm saying. Look, I'm happy for you to show me data what happened in the last 3 years. I agree with you. They went crazy. I don't think they're going to go the same way. If anything, I think you're going to see a drastic reverse of those markets.
Yeah, we've been chatting about this. I think that this COVID clarity is what they're calling. A lot of people have gone, you know what, I want a better lifestyle. So I don't need to commute to the CBD every single day now. So it's those new COVID assets that sit in the middling areas, which are still striking distance of the cities, are the ones which will continue to perform, even sort of up through Central Coast or Newcastle, even Wollongong, right? They're high performing, and everything in between is still holding very, very firm. But as soon as you start getting into two-half basket, 2 hours in a car, 3 hours a car, 4 hours in a car, it's a very, very different paradigm now. So, and you will see that balancing out quite a lot, even sort of, further out. But that said, Kiama was one of the top performing property markets in Australia over that COVID period. Kiama, fair enough, is still striking distance to the city. You can jump on a train there and you're in town probably within about 2 hours, I would imagine.
On a train, you could absolutely, mate.
On a train. So that's sort of one of those middling areas which are still providing all the benefits of having those that COVID style attractiveness to lifestyle assets, but still being practical. And hence the reason why places like that have absolutely gone nuts. And I would imagine places like Kiama would hold over time. Because fundamentally things have changed. And Kiama and areas like Kiama with a similar sort of demographics are practical for Australian workers.
Completely, mate. I think that's probably the key delineation between this is that you've got to be within striking distance and what's deemed to be striking distance of major commuter hubs, tertiary education, hospitals, as well as employment hubs, employment nodes, where you've got high-paid workers who choose to live a little bit away from where they would otherwise have had to have lived. You're a classic example, Phil, talking about the Central Coast. I live personally just an hour south of the Sydney market by the beach. I can go to the city. I'm in the city at least a couple times a week, but I choose to go when I need to go. And every single major CBD in Australia has those areas which are desirable and those COVID clarity markets, like you said. I think it's those markets, once you start to get beyond a driver commute, as well as any public transport ability, and no real airport infrastructure, no one who's sort of there for reasons other than, hey, I live local, I work local. Outside of that, they're the markets that did do really well. They were those classic regional towns. And I won't list them off because I think there's going to be no shortage of them in every market, but expect them to be the markets which, if people bought a second holiday home, and they're probably if you think about them as a classic holiday home market, they're the markets. Because once people say, where would you buy a holiday house? They're usually a bit further out because that's a holiday home market because you just can't commute there. They're the markets which people look at saying, oh. So
the benchmark then, the new benchmark for whether or not real estate is good, Paul, it's directly connected with the Smart Property Investment Show. If you live more than 2 Smart Property Investment shows away from your home to get the work, it's too far.
Yeah, it depends who your guest is, man.
It depends who your guest is. Just conscious of the time. That gives you about an hour and a half. Two Smart Property Investment shows, about an hour and a half. Any longer than 2, if you start out of your driveway, you listen to me twice, and you're not at work, too far away. Not good for you.
Sell it. Don't buy it.
Sell it now. Sell it now.
Sell it now.
Paul Glossop, Director of Pure Property Investment. Thanks for your time, mate. Always enjoy it.
Thanks for having me again, bud.
Nice one. I hope you enjoyed that, everyone. Lots of other stuff from Paul. Go and check it out on the Property Investment Podcast Network, wherever you're tuning this right now, or on smartpropertyinvestment.com.au. Remember social media, Smart Property HQ, if you want to keep connected with what's going on in property. And please, those reviews, keep them coming. As I mentioned at the top end of this podcast, the team get a real kick out of it. It's nice to know what we're doing is actually making a difference, and it's why we do what we do. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.